the asset reconstruction company. It is the oldest that we have, practically speaking, in terms of revitalizing distressed assets. But I don't know if the record is very good, Rashesh. For starters, ARCs are what, 2 decades old in India? What do they have to show?
Actually, ARC
1.5 decades.
ARC is about 11, 12 years old. But, if you go back to the history of ARC, there are some, it has evolved. Like, one of the fundamental questions about ARC has been, are they agents of the bank or are they risk capital providers to the banks? So if you see the origins of ARC, they were supposed to be agents of the bank. Even before 595, we had 0% by ARCs. So ARCs became recovery agents of the bank. Then RBI came and said, 595, now it is 1585. I think we are going slowly towards ARCs becoming risk capital providers on the bad assets to the bank. And on this front, ARCs are fairly new. It's only last 3-4 years. And as you said, there are special situations funds and ARCs. But now RBI is truly seeing ARCs as providers of risk capital to the bank, in part becoming pari passu investors with the bank in the bad assets and all. The other fundamental evolution that has happened in the ARCs is, earlier they were, as I said, agents. It was an outsourcing job. Now they're truly becoming owners of the new assets. So even that has started to change, and even that is last 3-4 years. I think ARCs have done a fairly good job in the last 3-4 years in a couple of areas where there are smaller loans under 500 crores, because then the banks have been able to sell it at a reasonable price. If you go to a banker and there is a 100 crore loan which has real value of only about 35, the bank is happy to sell it at 35. But if it's a 5,000 crore loan, the banks don't have the capacity to take that kind of a haircut. The other areas ARCs have had a fairly good track record is in financial restructuring. So our own experience in our ARC has been that wherever there's a financial restructuring, either you sell the non-core assets, you convert debt into equity, you put in some what is called priority funding, you provide the last mile financing to complete the projects. On all of that, especially for smaller loans under 1,000 crores, because if it's a 1,000 crore loan which I bought for 300 crores, I have to give another 40-50 crores to just clean up the last mile financing. It's within the capacity of the ARCs. And ARCs have done a reasonably good job in this arena.
There's just one doubt I had from the way you described the process. It's been very difficult to throw out a bad management. So it looks like at the end of the process, the banker would have lost 65%, but the promoter would have got a good company.
Not always.
Is that how it works?
Not always, because we ensured that even when the 1,000 crore loan is, say, given at 350 crores, the other 650 crore is not a haircut that is provided. This is what the bankers have sold to the ARCs. But the ARC and the bankers still have upside. And it is a job of the ARC to make sure that if it's a good asset and there is equity value creation, as earlier the example we saw, that the banks do get some of the upside. But the upside should come out of recapturing the value rather than trying to sell the asset and things like that.
Doesn't the promoter get more of the upside and the bank maybe a delayed and diluted upside?
I'll give you an example. We acquired an asset, the promoter owns 70% of the company. Again, a 1,000 crore loan at 350 crore and all that. The promoter owns 70%. He's obviously, the original answer was, I'll keep all the upside. You have taken the haircut. Unfortunately, thank you very much. We sat with him and said, no, we need to have some equity for the haircut that is being taken. He offered 5% of the equity, so he will keep 65 and you will take 5. We said, we'll keep 55 and you keep 15%. And it started. And ARCs can do something like this because, as I said, this is all financial restructuring. Eventually, we have agreed at a 40-30, where the 40% of the upside comes to the banks and the promoter still keeps 30%. So we have to be pragmatic. It has to be win-win-win. It has to be win for the company, win for the promoter, win for the ARC and the banks also. Because you can't just take an extreme answer where, either you throw out the promoter, because in a lot of these cases, you need the promoters. Because there are so many things in the company about, TDS and statutory dues and all of that.
Now the rule is that 100% FDI is allowed and 100% ownership is being contemplated by one owner, not yet allowed. Plus, you can sell the security receipts to NBFCs. So, Jayesh and Mr. Shroff first, is it going to make a big difference? The FDI?
I think so, because in the past, some of the foreign credit wanting to come in used to say that why should we come in if we are not going to get full upside? So, and there are, I think, 9 or 10 applications lying with RBI. Some of them are people who want definitely 51% plus, if not 100%. So that is going to be a game changer. Even the SRs, I think there's another aspect which is still needs to be completely resolved, which is this 15% funding. My understanding is RBI came out from 5 to 15 or from 0 to 5 and then 15 is that to push the banks into doing transactions at more realistic value as against completely cashless and the sale values are not really mapping the market value. If that is the case, then how does it matter whether 15% is generated by the ARC on its own or it gets a third-party funding? Which there is no clarity. We believe RBI should be indifferent, that ARC can issue structured products to then get funding for the 15% or even take a bigger stake and then take the equity upside, because if the banks have not succeeded in doing the workout and if the ARC is going to do the workout, then the larger part of the equity upside should be going to the ARC because that's what they're doing. And there's one other interesting concept, two related points actually. You know, from the beginning in the SARFAESI Act, we had this change of management. RBI took some 10 years to come out with norms, therefore no change of management happened for the first 10 years. Even after the norms have come out, I'm not aware of any single instance where change of management has happened. One unworkable provision is that when the lender has recovered the amount, you're supposed to hand back the management for free. Now, why would anyone come in to run an industrial outfit to help the creditor recover the money and then just walk away? I mean, I think we need some serious...
I thought the RBI was cognizant of it and wanted to change the rules.
Hopefully.
I think this is part of the SARFAESI
Act itself. Yes.
So,
no, I'm not blaming RBI for it.
So this is the law, and
this
until the law is amended, this will happen.
In fact, there was a...
Is it part of the amendments that is
I don't know,
being contemplated?
I don't think so, but there was a 2011 committee. I was on that, and we made these recommendations strongly that. And therefore, the related point is, you know, we talk of even in the SDR wanting to change the management and not just the ownership. You know, are we looking at bringing the concept of managing agency back? I mean, if you look back...
But should we not?
I believe so, because it's time we start looking at and valuing specialization. Why the managing agency will work is, that's the guy who's going to come and battle out the promoter if the promoter is not cooperating. That's the guy who's going to come and deal with the various regulatory authorities, licenses and whatnot, and ensure the plant continues running, economic value is not being further destroyed, and slowly start increasing the economic value. So he has to be compensated for that, and that compensation can't be that, okay, we give you annual 0.5% or 1% management fee. Again, economic upside has to be there without any investment, financial investment being made.
So you're speaking about two changes really. Managing, evolution of a management agency. But can we really just wish it? Because this is a whole profession and an institution that has to evolve. Wanting it doesn't mean it will get created.
No, evolve in the sense it can happen. I don't think you need to wait for the ecosystem to come in. There are enough Indians, for example, who have done this outside India. And they're happy to come back.
Do you want the rules to change so that they get a better deal?
I think the market, the slot in the market is there. They just need to be protected from some of the risks in order to allow them to come in.
Okay. So that would require rewriting
That would require, I think it would require two things. One is a sort of a change in the approach of the regulators and the judiciary, because they would be the ones who would eventually visit the risks on them. And perhaps an enabling change in the regulation which would give them some kind of indemnity cover.
In the SARFAESI regulations?
SARFAESI, Bankruptcy Code, Companies Act, whatever. I think it will be
in the Bankruptcy Code as it is currently, as it was discussed, we don't know the final version. Is this taken care of to protect the new management from previous sins?
I think the law itself would, given the manner in which the sort of bankruptcy code is contemplated, the law would protect it. Because you could draw a line and say this was the past and this is the future.
I'll just add one small thing. As you said, I think this FDI 100% allowed, sponsors 100%, new investors buying SR, is all part of the RBI move for ARCs to be a conduit for providing risk capital in the bank. And I think this is a very positive development. And I think all ARCs will also have a fund underneath. All of us are contemplating a 3,000, 5,000 crore fund, a special situation fund, so that the ARC model and the fund model can go hand in hand and truly start providing risk capital to the banking system, which will be used for the banks for future growth and all that. And I still believe that the ARC is not the only answer, but they will be one part of the answer to get this asset transfer and the risk transfer done.
Okay.